Hi, in this video we're going to be looking at the pros and cons of inflation. Inflation is of course where we have an increase in the general price level within our economy, so prices are increasing and so the value of our currency is falling. And we're going to use dollars here as our currency, even though I use pounds here in the UK. So we're going to start with cons because I think these are more well known than the benefits of inflation. We often view inflation as a bad thing, but we will discuss whether we do think inflation is in fact a bad thing. But let's begin with the cons. And one of the major ones is that inflation leads to reduced real wages. So imagine that we are earning a salary of say $30,000 per year. Well, if we have inflation, well, as we can see here, this says that the value of a dollar is going to decrease, so this value of $30,000 is effectively going to decrease in value because the price of everything in our economy is going up, but this $30,000 figure is staying the same, so we can buy less with our wages, so the value of our real wages has decreased in effect. So this is obviously a bad thing, and this is why people often think inflation is a bad thing, because we can buy less stuff with our money, and so people and workers are going to be worse off, and they're going to be able to buy less, and their standards of living are going to fall. So that's a key negative of inflation. Linked to this, we're also going to have reduced value of savings. So if we have $100,000 in our bank account, well, again, the value of each dollar is going to decrease, so the value of our savings is going to fall. So if we've saved this up over our lifetime, it is going to decrease in value. We can buy less with our savings, so our retirement may not be as nice because our savings have reduced in value thanks to inflation. So that's another thing that people will see as a negative thing, because we can buy less with our money because the value of money is decreasing. Tied in with this is that we have fewer funds available for borrowing, and this would come about because we have this reduced value of savings, and because people's value of savings is going to fall over time, we may see that people actually decrease the amount they save. And say if we have a 10% level of inflation, then people are going to say, you know what, I don't want to just have my money sat there in a savings account and it's just decreasing in value over time. What I might do instead is just spend this money. And the problem with this is that when people borrow money, what they're effectively doing is borrowing it from people that are saving. They're using money that other people aren't using, that they've got sat in a savings account. And so if people aren't saving money, then this is going to leave fewer funds available for borrowing. Why is this a problem? Well, one of the key reasons that people borrow is to increase their investment. They borrow so they can invest in things, and this is particularly the case with businesses where they're looking to, say, innovate, build a new product, or potentially grow their business. We can just say that investment can increase economic growth and long-term economic growth. We have increased innovation, we have businesses expanding, so fewer funds available for borrowing is a bad thing that can result from inflation if people reduce their savings because their savings are decreasing in value. So that's a potential knock-on effect. Might not necessarily be the case, but it's a potential negative impact of inflation. The next drawback of inflation is going to be reduced competitiveness. And so when we think of competitiveness, what we're thinking of is international trade with other economies. So why is inflation giving us reduced competitiveness? Well, as we've said up here, we say inflation is an increase in the price level in our economy. So if prices are increasing for our domestic goods, this is going to increase the price of our exports. If other economies are demanding our goods, these are now going to be relatively higher priced because we have inflation. What will this mean? Well, it's going to mean that we sell less to other economies. We have fewer exports because these higher prices mean that other economies are going to demand fewer of our goods. They're going to demand less exports. Tied in with this is the fact that this is going to make the price of imports seem relatively lower. If we have really high inflation and our prices are going up, our imports are going to seem cheaper because these won't necessarily be increasing in price. So this means that within our economy, we're going to be demanding more imports, which we write as M, which is maybe confusing. We often see this as an I. So if we have reduced exports and higher imports, this is going to give us what is called a balance of payments deficit or a trade deficit, where we're importing a lot more than we're exporting. And why is this a problem? Well, this reduction in exports is going to mean that our domestic businesses have less demand for their products. Other countries aren't demanding our goods as much, so our local businesses are going to suffer from reduced sales. Equally, if we're increasing our imports instead of demanding our own goods and demanding goods from local businesses, again, demand for our domestic products is going to fall because they're increasing in price relative to the goods of other economies. These two things will mean that our local businesses are going to suffer. They're not going to have as much demand, so they may go out of business, and this can lead to higher unemployment within our economy, which is obviously a bad thing that can come around from inflation. Through this point, we have reduced competitiveness, that we're going to demand other economies' goods more because our goods have increased in price. So the next point is that we have increased uncertainty due to inflation. And this is not just because we have high inflation, say if we have inflation of 10%, but also because if our inflation is higher, it will often be more volatile. And this means that this inflation will just fluctuate a lot. If we have 10% inflation one month, the next month it may be up at 15% and then down to say 6% and so on. And this will kind of go up and down, but prices will change at potentially an irregular rate. And this leads to uncertainty, say, for individuals because they don't know what prices are going to be, but also for businesses who don't know what their future price is going to be. It gives a lot of uncertainty around the economy. Will the Bank of England, say, change the interest rates to correct this inflation? Will there be some sort of government policy to address it? And what are prices going to be in the future? There's a lot of uncertainty surrounding high levels of inflation. And this is a problem because, and we sort of tie into this point, this investment idea, that there were fewer funds available for borrowing, but people or businesses won't necessarily want to invest in projects if they don't know what the economy is going to be like in a few months or in a year's time, because these investments are often long-term investments. And so if you can't predict what's going to happen in the economy, you're less likely to want to invest. And this is one of the key reasons why we see uncertainty as a problem in all walks of our economy, because this reduction in investment, as we said before, is going to lead to reduced economic growth, because investment is very good for our economy. It gives us innovation, it allows businesses to expand, so uncertainty is going to prevent that. So that's a negative of inflation. The next one is what we call shoe leather costs. And the reason for this name is it's actually referring to the fact that you have to shop around a lot if you are a consumer. You have to walk from shop to shop looking for a fair price. So you're going to actually lose value on your shoes, or the leather of your shoes is going to be worn away because you're walking around shopping at different stores looking for what a good price is, because the prices are changing. Again, we've said that if we have, say, 10% inflation, and this might be 15% one month, 6% another month, and so consumers are going to have to shop around to find what a good price is because prices are changing so much. And this isn't just a problem because it's going to wear away your shoes, but this is just generally a problem for consumers. They don't know what a fair price is. They may be getting unfair prices because the prices are changing so often. They again have this uncertainty about their spending. They don't know how much they should be spending in certain areas, and this can lead to a misallocation of goods. They're not buying the correct amount of products because prices are changing so quickly, and they don't know what a fair price is. And this is a sort of psychological cost as well as a physical cost. You're using up time, you're wearing down your shoes, shopping around. So that's another cost of inflation for consumers. The next one is menu costs. Again, another name which, well, it's kind of in the name, where this is the cost of updating your menus if you're a business. If you're, say, a restaurant owner and we've got 10% inflation each month, you're going to potentially have to update your prices and reprint your menu, which is going to cost you some money. But also think about, say, supermarkets, which have lots and lots of prices on their shelves. They're going to have to keep updating these. And across the whole economy, this can cost some money. And also we have this idea of updating costs can also be a psychological cost for consumers. You may lose business because you're constantly increasing your prices and your customers aren't very happy with you doing that. And also, well, one example I should probably throw in here is also reprinting of catalogues. Say, maybe not so much now that we have online stores and we shop online more, so menu costs have potentially decreased. But in the past, when you were printing off these catalogues, which were, say, hundreds of pages, and you'd ship out, say, thousands and thousands of these catalogues, it can be very expensive to have to reprint your prices and have to reprint a whole catalogue because inflation is changing the prices. So maybe in the past this was potentially quite a serious cost if there was really high inflation. Now maybe less so because it's quite cheap to update your prices on an online store, but still something that physical businesses have to update their prices regularly if there is high inflation. So the final problem with inflation is going to be poverty. And this is obviously quite a serious problem, an economy being plunged into poverty, and it will only really come about if we have really, really high inflation, what we would call hyperinflation. And hyperinflation is just defined as very high levels of inflation. I think some definitions may see this of inflation of 50% or higher. Other definitions may be more drastic, say 1,000% inflation. But the point is that it's just very high inflation. And particularly if we have inflation of, say, 1,000%, and we've seen inflation in the past at these levels and potentially higher, recently, say, in Venezuela, and in the past in the Weimar Republic of Germany after the First World War, we have seen levels of inflation that have been really, really high. And how does this lead to poverty? Well, it is just all these other cons that we've listed above, but just on a much higher level, where if we have inflation of thousands and thousands of percentage, or thousands and thousands of percent, our real wages are going to fall rapidly in value, and the value of our savings might just fall to pretty much nothing overnight. And so people aren't going to be earning much money, all their savings are not going to be worth anything, and we have all these other problems of, say, uncertainty. There may be no funds available for borrowing, your competitiveness is completely gone, that you can't compete and export any goods, and things like menu costs, you're having to update menus, and these can all contribute to putting people into poverty. If you have no wages and your savings are worth nothing, well, that's going to put your economy into poverty. You may not be able to afford food, and so you can have starvation, which is a serious problem that some economies have witnessed because of hyperinflation. Why does hyperinflation come about? Well, maybe a bit beyond the scope of this video, but say if you print lots and lots of money, the value of that money is going to decrease. And so that's what happened in Weimar Germany, and the Deutschmark fell in value dramatically, and we had poverty. So that is a potential negative effect, not just generally of inflation, but particularly for hyperinflation and really high inflation. This can lead, in some extreme cases, to poverty. So we've had lots of negatives of inflation, and at this point we may be thinking inflation is a very bad thing, but let's move on to the pros and the benefits of inflation and show that as long as we have low and stable inflation, this is going to be our key term for the remainder of this video, low and stable inflation is seen by most to be a good thing. What is low and stable inflation? Well, low is seen as around 2%. This is what a lot of major economies target for their inflation rate, and stable is just the fact that we have this 2% for, well, we hope that we can just maintain our inflation at or near to 2%, so it's not fluctuating, as we said before, with volatile inflation, where we're going from 10% to 15% to 20%, and so on. We want to just maintain ourselves at this low rate of inflation of 2%. So what does low and stable inflation allow? Well, it allows for the adjustment of real wages. And we had as a negative up here as our very first one that inflation causes reduced real wages. And this is true, but some economists would tell you that this is a good thing, so long as their our real wages are only decreasing in value by a small amount of this 2% a year. Because suppose that you have an employee that is earning £30,000 per year, but your business isn't doing very well. You need to make some cuts to your costs. Well, it's actually very difficult for a business to give someone a wage cut. And so if we have to cut back on our prices, a business might want to say decrease these wages to £25,000, but they can't really do this because, well, you may have employment contracts that don't physically allow you to take a wage cut, but also employees are going to see a big problem with wage cuts. They might go on strike or whatever it is just to resist this decrease in wages. It seems psychologically like a very bad thing to get a wage cut. So what businesses instead rely on is a little bit of inflation, which is going to decrease the value of our currency. And so this £30,000 over time is going to decrease in value. And so people are effectively getting a real wage cut, but we're not doing the psychologically terrible thing of giving them a nominal wage cut where we're not going to decrease the actual number that they earn each month. It's just this number is going to be worth less because the value of our currency is decreasing. So this is a useful thing, that inflation can help labour markets adjust and it can help businesses reduce their costs in real terms because the value of wages will decrease. And if a business is doing well, they can still give people pay rises, and so they can offset this increase in inflation. So it's not necessarily a bad thing that wages in real terms or that money is decreasing in value, because businesses should just increase wages in line with inflation if they're doing well. And if they're not doing well, they can keep wages the same and this will reduce their costs. And this fact means that they don't need to make people unemployed. Because if we need to reduce our costs and we can't give someone a wage cut, what we'd usually do is just make them unemployed. We have to just fire people to reduce our costs. But instead, we can just keep their wages the same, and these are going to decrease in value over time. So we don't have to increase our unemployment, which is obviously good. We see unemployment as a bad thing. So this is a positive of inflation. The next one is again tied into something we talked about before. We said that it's going to reduce the value of our savings, which is a bad thing generally. But also, inflation is going to reduce the value of debt, or the real value of debt. And so imagine that someone has a mortgage, which is potentially the main thing that people will often hold as debt when they're buying a house. If you take out a mortgage for, say, £100,000, and you're paying this off for, say, 30 years, well, if we have 30 years at 2% inflation, this £100,000 is going to decrease in value a lot. And by the time this 30 years passes, we're not actually paying off anywhere near as much money as we originally took out on our loan. We can pay off much less because the value of this £100,000 has decreased because the value of our currency has decreased due to inflation. So this is a good thing for people that are holding debt. And beyond this, it's usually seen as a good thing in our economy if people are taking out debt. It means people are spending, you're investing in housing, and also debt may be businesses borrowing funds. We want to incentivize people taking out debt so that they are spending money and sort of putting it into the economy, as this leads to economic growth. So reducing the real value of debt is a good thing. And similarly, this reducing the value of savings point can be seen as a good thing as long as we have low and stable inflation. Because if savings are reducing in value by 2% each year, this may again incentivize people to spend their money, which can increase economic growth. So that's a good thing. And these are sort of tied in with this point that we have at the bottom here, that it enables economic growth. Inflation won't necessarily cause economic growth, but there are some avenues that it can enable this growth, where we have adjustment of real wages, so we don't need to increase our unemployment, and this reduced value of debt and the reduced value of savings can stimulate spending in our economy. So this inflation can help enable economic growth through some avenues. So the remaining point here is just that deflation is worse than inflation. So we have to have some level of inflation in our economy. So what percentage of inflation are we going to choose? We've said above that 2% is the rate that we do choose, but why are we not targeting, say, 0% inflation? Surely we don't want prices to be rising over time. Or surely it seems like a good thing if our prices are falling over time and we go for minus 2% inflation. And this is what deflation is. It's just negative inflation. Our prices are falling over time. Well, clearly by this point, I'm sort of implying that this is not something we want. But why is that? Well, if our prices are falling over time, we have, say, each year our prices are falling by 2%, well then people will potentially just not want to buy anything. People will put off their purchases. Why would I buy a house for £500,000 today when I could just wait a year or say a month when the price will be lower then because prices are falling? And this is very dangerous for our economy if people are going, oh, price level is falling, so I don't want to spend anything. This can actually cause what we might call a deflationary spiral, or just where this problem just keeps perpetuating itself. So if we have, say, reduces in our price level, people will reduce their spending or their consumption, and this may cause businesses to close down because there's a reduction of sales for certain goods. They can't sell anything, so businesses have to close, and we have an increase in unemployment. This is obviously going to reduce our wages, and so if people have reduced wages, they have less money to spend, and so they're going to reduce their consumption again. And again, this is going to cause increased unemployment, reduced wages in our economy, people are earning less, and so on. And all of these things are going to reduce our economic growth, reduction in economic growth, reduction in economic growth. And these can all actually contribute to reduced prices. Prices are just going to continue to fall more, which is going to make us want to spend even less and less. And this cycle sort of continues, and deflation can mean that we just have negative economic growth. We can be thrown into recession because people are just putting off their purchases. So this is obviously not a good thing. And again, this ties into this final point, which is a bit controversial, I must say, that inflation enables economic growth. Not everyone agrees with this, but the point is that if we have deflation, then we may have negative economic growth. So the only way to have some economic growth is to have a bit of inflation, and this is why we target 2% inflation rates rather than 0%, rather than minus 2%, because inflation is generally seen as a good thing. These benefits are good, and they outweigh these drawbacks, because if we think about it really, all these cons we've gone through, this reduction in real wages, as long as our inflation is low and stable, they're only falling by 2% each year, and we've actually said, you know what, this is a good thing. This allows our labour market to adjust and makes it more flexible. Reduced value of savings, again, it's only by 2% each year, and this can stimulate spending in our economy, so this can be a good thing. Fewer funds available for borrowing, it's not going to be a massive issue if there's only 2% inflation. Reduced competitiveness, again, most economies are going to have at least 2% inflation, so if we have 2% inflation, we're not going to have reduced competitiveness because the prices of every good across the world is going to be increasing in value, so this isn't going to be a problem. Uncertainty isn't going to be a problem. If we have 2% inflation year after year after year, we are going to be certain about what prices are doing because this isn't volatile, this is stable inflation, so that's not a problem. Again, people aren't going to have to shop around, people aren't going to have to update their menus very often because it's only 2%. They can just update their menus, say, every year or every 2 years because their prices are only decreasing in value by a couple of percent each year. And this poverty is not going to be a problem because that's only really a problem if we have hyperinflation. So that is why inflation is generally a good thing, just as long as we have this key term, which I think I noted down here, low and stable inflation. That is the term of the day. We like low and stable inflation for the reasons we've given above. So that is why we target 2% inflation and not 0% and not minus 10% inflation. On the topic of inflation targets, make sure to check out this video which looks at the problems with measuring inflation, so we may not actually be on target when we think we are. And of course make sure to like this video if you found it interesting and subscribe to add some econ to your subscription feed.